The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Live from Studio 2 at Bloomberg headquarters in New York, I'm Katie Greifeld.
And I'm Matt Miller. We are kicking you off to the closing bell here in the U.S. And we want to get a check, first off, on where markets stand. So take a look at the equity indexes here. You won't see bonds today because the smart money is closed to celebrate Columbus Day. But equities continue to trade with the S&P up 1.4%, gaining 93 points. So just about half what we lost on Friday. That was a monumental drop, the first time we were down below 2% since April. The NASDAQ was off 3.5%. We've clawed back 2% of that, a 500-point gain on the NASDAQ. Gold at another record high, $4,100 and change a troy ounce. And oil, although it's coming up, coming from very low levels. So NYMEX crude still holding, Katie, below $60 a barrel.
Well, let's get back to that equity market, because is it buying the dip or is it buying on OpenAI? The S&P 500 heading towards its best session since May after Friday's China trade fuel sell-off, mostly on optimism that the U.S.-China negotiations could remain alive, that buy the dip mentality, but also alleviated fears about a tech-fueled bubble. Now, chipmaker Broadcom, on part of a massive part of today's moves. I said that wrong. Anyway, it's surging after OpenAI agreed to buy the company's custom chips and networking equipment in a multi-year agreement. But really, today's market action somewhat overshadowed by a monumental piece of history, and that, of course, is peace between Israel and Gaza. President Trump is kicking off his global summit on Gaza's future in Egypt as he aims to ensure the U.S.-led truce in the Middle East is lasting. 20 remaining Israeli hostages were released today, as were 2,000 Palestinian prisoners, with Trump hailing, quote, a dawn of a new Middle East. Meanwhile, further east, Trump's tensions with China still brew, but not enough to quell risk appetite on Wall Street. The Trump administration has softened its previous stance that fueled Friday's slide, signaling that they're still open to a deal with China. We heard from Treasury Secretary Scott Bessent saying that he still sees a Xi-Trump meeting in the future and that all options are on the table.
The U.S. can only withstand so much pain here. So I would say the Chinese have the advantage, but the Trump administration can play, can punch back pretty hard.
Trade war, even the version that we saw before Friday, is behind a worrying trend for economists. This is inflation as measured by the CPI. Of course, it won't be coming out on Wednesday as it normally would. They are going to release it a couple of weeks later, but it's been trending higher and higher. And that's because you have a number of these components. Food, for example, continues to trend higher in blue. In purple here, core goods, those good prices getting bigger and bigger. And in red, what was taking away from it previously, energy, those energy costs are starting to contribute to inflation. What you do see is core services getting smaller and smaller, but not by much. I mean, you can't see it with the naked eye. That's because shelter is coming down, but healthcare costs continue to rise, Katie. So inflation starting to become a major problem again for the U.S. economy and possibly for the Fed.
Well, Matt, let's kick things off with Oscar Munoz. He is chief U.S. macro strategist over at TD Securities, joining us now to kick off the show. Oscar, great to have you with us. You take a look at your resume. You are consistently one of the top-ranked forecasters for U.S. CPI when it comes to Bloomberg polls. So let's talk about what we might have gotten on this Wednesday. That's when we were supposed to get U.S. CPI. The government still shut down. We know that the BLS will publish the September report on October 24th. What are you expecting that the readout could be for this economy?
Thank you. Thank you for the invitation. And yes, I'm just very excited that we're actually going to get some government data finally. I think just the news that we're going to get inflation at the end of next week is very positive news. And going back to your point, we're still working on the forecast, but we are looking for a core CPI that's probably closer to what we saw in the last report for August. I think we're going to see continued, particularly focusing on the goods segment. I think we're going to see more pass-through there, which is something that we could continue to forecast for the end of the year and Q1. We expect pass-through to gain momentum and to lift inflation going forward. But also we have to pay close attention to what's happening in services because we know a number of Fed officials are concerned about the second round effects from goods-driven inflation to services, which would be a problem for the Fed if they continue easing.
Well, I agree with you. The fact that we're getting any data at all is pretty exciting. But let's talk about what this means for the October CPI report, because Bloomberg Economics points out that the BLS, it's not going to be collecting data, not collecting the full range of prices that they need to put together October's report. So we're going to get probably a clean read, the cleanest read that we're going to get in a while for the September figure. But as we get into the future, as we work through some of the noise there, what do you think that means for the Fed, and what do you think that means for investors?
Yeah, it's just more uncertainty, right? Apart from the trade policy announcement from President Trump on Friday, which increases uncertainty on the policy front, we're also going to get uncertainty about what's the real inflation that we're going to get. Clearly, the collection of prices for October is going to be affected. We saw a similar episode in October 2013, also when we had a shutdown, where 70% of prices were collected. So a lot of the rest was imputed. So to your point, I think the cleanest read that we're going to get for inflation will be the September report released next week. And then we'll see what happens with October. But the Fed has to take that number into account. It can't do much more apart from that, given that the BLS is constrained in terms of the collection period and the resources that is assigned to it.
Oscar, I want to ask you about the shelter portion of this, which obviously is a huge piece of the inflation picture. Last week, we got mortgage purchases, which showed that purchase applications are down 2.5% over the last 6 months, even as the 30-year mortgage rate has come down by 20 basis points. And Neil Dutta says the fact that homebuyer demand has declined, even as rates have dropped, suggests that a deflationary psychology has infected the housing market. He said home prices are likely declining too. Would that be something that you could consider as a possibility? Because we haven't seen that since the great financial crisis.
Yeah, that's correct. I have to agree with Neil. I think that the housing market is basically frozen. I think you need to see a meaningful decline in mortgage rates to see the market revive in terms of transactions. I think in the meantime, the leading indicators that we have for rents in particular are suggesting that rent prices should continue to lose momentum into 2026, particularly for this report that we're going to get next week. Remember in the August report for CPI, you saw an unexpected increase in rents and OER, which was a big driver for services inflation. We're actually looking for mean reversion next week in that report. And as I mentioned before, I'm looking for additional easing from shelter over the forecast horizon. So that should be positive news if you're concerned about services inflation in the U.S.
If the Fed does continue to cut rates, Oscar, as inflation rises, what does 2026 look like? I mean, does that necessarily fuel inflation that climbs above 3.5% up to 4% and beyond? Or will a weak labor market, a potential recession, hold us back from that?
I'm actually in the camp of the latter that you mentioned. I think for me, the risks are to the downside for the labor market. If you look at the data, we're in the early stages of tariff pass-through. Businesses are, for the most part, absorbing the shock. We know this from earnings calls in Q2. And we have also heard from businesses talking about increasing the tariff pass-through going forward to consumers, right? If that happens, that will have implications for real wages, consumer spending. We also expect the unemployment rate to continue increasing. So for me, given that we're at the early stages, if you look at the effective tariff rate, is running at 10%. We're expecting that to go up to 16 to 18%. So we're half through where we should be. So I don't think we're out of the woods yet in terms of the impact to the economy. And that's why I mentioned that for me, the risks are to the downside for 2026.
All right, Oscar, great to get some time with you. Appreciate you stopping by. That is Oscar Munoz. He is Chief U.S. Macro Strategist over at TD Securities. Now, coming up, gold's on a glittery run as it tops $4,000 an ounce in a rally that's nothing short of precious. We'll discuss the metal's next path with ABAXX Technologies CEO Josh Crumb. This is The Close on Bloomberg.
precious metals adding to their banner year as a silver short squeeze props up prices and geopolitical tensions fuel gold's rally. Central banks and ETFs have helped gold outpace the major averages in the Magnificent Seven so far this year. Joining us to talk more about that and his business is Josh Crumb, the CEO of ABAXX Technologies, which operates an exchange out of Singapore that offers gold futures contracts and builds software for commodities trading. You actually do a ton of different things at ABAXX. I've been studying, looking into this company. What's the core would you say, of your business? How would you describe your mission statement?
Well, I think it's all about modernizing the infrastructure for trading commodities, right? Whether it's the new types of contracts as the market changes, like, we've got obviously highly liquid futures for something like, Henry Hub natural gas, but liquefied natural gas doesn't really have a price or a deliverable futures contract. So part of it is the modernization of the commodity trades and benchmarks themselves, but also, and one of the things that we're super excited about is the technology. Opening up commodities to be collateral and be used in real time through tokenization. So it's really, we've got a very old school part of the business, and then obviously a lot of modernization that we're working through.
Yeah, when it comes to commodities, I feel like it's such an interesting market and there's so much room for funkiness because you do have an actual physical asset and then you have futures, and I feel like that dynamic is maybe more dramatic than it is in other asset classes. So when you think about what's going on specifically with gold, this record run, how is that playing out between the physical and the futures, and how is that playing out across geographies? Yeah,
it's a great question because that's actually one of the big problems. A lot of these, like look at silver today, it's just incredible what's happening in silver, and gold has been going through that over the past few months as well. And it's as much as the problems of old market structure as it is just the fundamental supply and demand. When you've got this gap in markets between what's happening in sort of balance sheet gold at the LBMA, that's traded like FX on the spot, and you're trading against a bank's balance sheet in gold or silver at the LBMA versus actual deliverable futures and warehouses in New York, it's because you have these different market structures that we're having these problems. So, I used to joke when I was at Goldman, sometimes as much of the trade was sort of arbitraging the rules of the exchange as it was the actual, again, fundamental supply and demand. So again, that's where when we launched our exchange in Singapore, it's very focused on bringing, real-time settlement and technology, spot markets that are physical in vault, and futures markets that all converge in the same modern market infrastructure.
You talk about physically delivered futures. How is that possible? I can't wrap my head around it.
Yeah, so it's all about when your contract expires, what is the contract that the buyer and seller have to perform on, right? And then being a clearinghouse, you're not only clearing the derivatives and guaranteeing the performance of the derivatives, but you're also mutualizing the risk and making sure everybody guarantees the performance of the physical contract. So that's why someone can't just walk away from a corn futures or something, right? And that's the same thing so we have to work with the physical trading industry to come up. What are the contracts everyone agrees that no one's going to walk away from when the derivative comes to expiry?
So Matt said it at the outset that you do a lot. Are you currently involved in the silver market?
We will be launching a silver contract. We're still waiting on some regulatory approvals, but that will be one of the next contracts, very similar to our gold market structure. So it'll be a spot physical bars in vault in Singapore, a deliverable futures, and then again, after our pilots of our technology, also have a real-time title transfer facility for using gold and silver as high-quality liquid assets, being able to use it as collateral in the financial system.
I have a curveball here.
Oh, perfect.
Okay, so you also do like digital identity verification, that kind of thing on the blockchain. And last week I was talking with Bruce Richards about First Brands, the bankruptcy, and he said, if we had like with Tricolor, for example, if we had VINs on the blockchain, if we had the collateral on the blockchain for First Brands, you wouldn't get these areas of confusion where maybe something has been promised to two different lenders. Have you thought about that kind of business?
That's exactly what we're working on. Absolutely. Yeah. So again, using gold as an example, gold is now the largest piece of central bank collateral and holdings. About a quarter of central bank reserves are now gold. It surpassed treasuries. But if you look at the 1 trillion, roughly 1 trillion in collateral sitting in, in clearinghouses for clear derivatives, it's just it's a rounding error that people use metals as collateral there. And the main reason is, what is your metal? Like, how quickly can you find it? Is it balance sheet gold in London? Is it a bar, a 100-ounce bar sitting in a COMEX warehouse with a somewhat outdated system for record keeping? So by creating the digitization, and actually our technology is a little bit different than blockchain. If blockchain is reconciling a ledger with every party distributed, we reconcile legal claims with particularly the underlying identity and who's signing. So we actually have,
for example, receivables, right, that should go to Bonita Point. Maybe they're promised to somebody else.
Exactly. So right now, blockchain, if you're talking about real-world assets, it's just a ledger pointing something offline, right? Whether it's Circle holding reserves and or some other custodian holding stock, and then the blockchain points offline. What we're doing is real-time reconciliation of the actual like bill of lading on a ship or title or a warehouse receipt. So we're reconciling legal claims instead of reconciling a ledger, which we think is more important, because at the end of the day, if the asset lives in the law is what matters.
All right, Josh, feels like we're just getting started. Unfortunately, we have to leave it there. Come back soon. That is Josh Crumb. He is CEO of ABAXX Technology. Now, coming up, we'll speak to Richard Haass. He is the President Emeritus at the Council on Foreign Relations, about whether the U.S.-led truce in the Middle East can turn into lasting peace in the region. This is The Close on Bloomberg. Well, history in the making, with President Trump declaring that the war in Gaza is over during remarks at a global summit in Egypt. Global leaders gathering at the signing ceremony to celebrate the ceasefire deal, which was secured after days of negotiations brokered by the U.S. and others. Here to discuss, I'm pleased to say, we have Richard Haass. He is President Emeritus of the Council on Foreign Relations. Fantastic to have you with us. So the point has been made that now the hard part starts. Of course, the negotiations, very difficult, very complex, but talk us through what the rebuilding looks like and guaranteeing that this agreement will last and be sustainable.
Well, just to be fair, Katie, what was accomplished was also difficult. Nothing in the Middle East is easy. And there's a lot of credit to go around just to get us to this point. And there's reasons to celebrate, obviously. But that said, you're right. I'm not fighting your basic point. Certainly the harder part is to come. One is to make sure the ceasefire holds. There's questions about the role of Hamas and how does one try to promote disarmament? What does one do to get enough food into the area? How does one create security in the area? What about governance for the area, and so forth and so on? And that doesn't even get to questions about the future political process between Israelis and Palestinians. So there's any number of difficult challenges, but the most basic is to create conditions of order, of stability. And that at least creates an environment in which you can begin to address humanitarian issues, economic rebuilding, political governance, and so forth. That is the prerequisite, stability and order, for all else.
Well, I guess to that point, and you list a number of potential issues here, potential questions when it comes to disarmament, governance, rebuilding, the list goes on. But when it comes to enforcement, I mean, what do you think that the administration, the Trump administration, is prepared to do here?
Well, the critical part of enforcement would probably come from this international or Arab stabilization force. And it is going to have to be militarily capable, because you can't assume you have a permissive peacekeeping kind of environment. There are likely to be challenges, whether it's from Hamas or some other group or individual that is there. So that is, I would think that is the most basic. You can also try to make economic help contingent on certain types of behavior. If Israel wants to respond to some type of incident, you may want to say, look, that doesn't cross a threshold, hold back for now. So I think there's things you can do to incentivize certain kinds of behavior. But the most important thing is putting into place an international force that has enough capability to deter armed attacks, and if and when deterrence doesn't work, to respond to them decisively.
Today is a day when I think a lot of President Trump's critics have come out and given him credit for this. Really a monumental achievement, an historic achievement, as we've been saying all day. Certainly the freeing of the remaining hostages by itself is a pretty amazing feat. And he credits, not only his team, but his sort of art of the deal, his negotiation style, which is, not typical of a U.S. president. Do you think that that's a huge part of this, a big part of this, Richard? And can he use that now to solve the Russia-Ukraine war?
Look, he does deserve credit, but also he was able to operate in a context that was conducive to diplomacy. Hamas had been militarily weakened, as had Iran, its principal military benefactor. Iran is also economically in dire straits. The Arab countries wanted the situation to settle down. And then he was in a position to put pressure on Israel. But again, none of this should diminish the fact that the president did an interesting thing. Rather than waiting for every I to be dotted and T to be crossed, he essentially said, we've got a deal. Don't you now get in the way of it by raising this or that question. So I think he put some very effective leverage on both the Israelis and on Hamas, and has succeeded. I think the fair question is whether such an approach will succeed going forward. One can hope. I just think that history leads you to be somewhat more sober about it.
Speaking of leverage, J.D. Vance was on the Sunday talk shows, or on Fox, I believe, yesterday, saying that the president has more cards in this much colder, thankfully, war between the U.S. And China, a trade war. On the other hand, Meredith Whitney was out yesterday with a note pointing out that China's Ministry of Commerce has said it will ban any export of critical minerals to the U.S. for military purposes. And she points out, at least as far as she knows, that a lot of those big defense contractors, Lockheed Martin, General Dynamics, may be almost out of critical minerals. And some, like GE and Fluor, are depleted completely. How serious is this issue?
It is a serious issue. My basic point would be both the United States and China are in a position to hurt one another. We don't want to see mutual assured destruction here. But the United States has allowed itself to get into a situation where its dependence upon Chinese rare earths and certain components is truly unhealthy. And that is something that will take time to address, time to reduce. But in the meantime, yes, China has significant leverage. We have some leverage over China in various ways in terms of technology transfers and so forth. Again, you've got the meeting between the President Xi Jinping and President Trump scheduled in a few weeks from now, potentially a summit sometime in the first half of next year in China. To me, the question is whether they can work out an economic relationship that makes economic sense and takes into account the military realities. I think it's possible, but it's not going to be easy. And I think we saw that what happened Friday, even though today we've seen both sides pull back a little bit from the brink.
What's interesting when it comes to the U.S.-China relationship, where negotiations have progressed to, or talks, whatever you want to call it, is that it feels like it's the non-tariff issues that have really taken center stage. We're talking about rare earths, of course. That seems like a very urgent part of this conversation. How do you think tariffs and the threat of more tariffs filter in here? We were talking to Jeff Moon on Friday. He's the former USTR under the Obama White House. His view is that they will be limited and ineffective, and I wonder if you share that view.
I tend to, because China has lots of ways of pushing back. We've seen it again with rare earths, certain things in supply chains. Also, China will be able, at least in part, to find alternative markets to the United States. One other factor also, which is going to come into all this, is going to be geopolitics. Economics don't take place in a vacuum. There's questions of the South China Sea, even more acutely questions about Taiwan. So when the two presidents get together, either in Seoul or next year in China, if the summit were to happen, it turns out to be a really big agenda, both economics and non-economics. And one of the questions is, are there any trade-offs between the two, or do economics get dealt with in their lane and geopolitics in its lane?
What's also interesting when you think about, how things are progressing with the U.S.-China relationship, I remember a few months ago, the Chinese side made it clear that they wanted basically delegates to come in and negotiate these trade issues. They didn't want the two leaders, President Xi and President Trump, to be in conversation with each other. But it feels like that is the main channel of communication. Of course, it's not the only channel. We know that they have teams on either sides. But it seems like there's so much focus on this meeting between these two leaders, whether or not they're going to meet in a week and a half. And that isn't necessarily how the Chinese wanted this conversation to happen.
Well, I'm not sure either president, I don't mean this as disrespect, is in a position to negotiate details about tariffs or export controls. Some of the most complicated meetings I ever sat in when I was in government dealt with export controls and technologies. And so I think that's too much to expect them to deal with. I think their job is to deal, if you will, with the big basic issues. And that's why you have, aides and staff to deal with all the details, whether it's tariffs, export controls, or anything else on the economic side. But they're going to have to set the parameters. And again, they're going to have to decide whether there's any trade-offs between economic issues and geopolitical issues. And I think that could be ultimately one of the really big questions to be decided either later this month or next year.
I want to finally ask Richard, about Argentina. Javier Milei is coming to the White House tomorrow. And of course, you've had Secretary Bessent say he wants to guarantee Argentina's currency with, I think, an additional $20 billion. Seems like they'll go through that pretty quickly if the market doesn't believe it. What's your read on the situation?
Well, I tend to agree. And the real question to me is, if you're going to guarantee something, what are the conditions? What is it we want from Argentina when it comes to economic policy, maybe even non-economic policies? We have leverage here. So the question is, what do we get for it? But to have an unconditional guarantee makes very little sense unless you think all they need is some financial help to get over some type of an obstacle. I don't see it that way. So I would think we ought to be linking it to all sorts of policy changes, which, by the way, would be in our interest and Argentina's as well.
Thank you very much. Richard Haass, President Emeritus of the Council on Foreign Relations, also a graduate of Oberlin.
There you go.
The great state of Ohio. It is just about 3:30 in New York. This is the Countdown to the Close. I'm Matt Miller with Katie Greifeld here, and we're looking at a bit of a bounce back in markets, to a large part that's driven, of course, by President Trump seeming to back down a bit on his trade threats to China Friday. But also, it doesn't hurt that Broadcom announced this deal with OpenAI this morning.
OpenAI hitting the press hard again this morning with another deal. You think about all the ructions that this private company caused in the public markets last week. That is continuing today. The chip makers once again soaring, helping us to dig a little bit out of the hole that we found ourselves in last week. But you take a look at the S&P 500 on the month. It's still down for the month of October, but certainly OpenAI just inking deals left and right helps a bit.
Right. We were off on Friday 180 points at the close, as you likely remember.
I was there.
And we're back up 100 points. 16 of that, almost 17, is from Broadcom by itself. Let's talk about that deal with Erica Brescia, Managing Director at Redpoint Ventures. Erica, there's been a kind of circularity that, is well covered over the last couple of weeks. But in my mind, this continues that, because OpenAI is going to have to fund the build out of 10 gigawatts eventually of power with Broadcom. The initial deal, I think, is a $10 billion deal, and maybe they'll use some of the $100 billion they got from NVIDIA, or some of the 10% AMD stake that they're getting from that deal. How do you see these transactions?
Certainly exciting and interesting times here. I think the reality is, and Jensen has talked about this too, that everything in AI comes down to chips and power. And if you are, trying to be one of the winners in this market, you need to ensure that you have access to both in perpetuity. Is the lifeblood of these companies. And I think OpenAI is making very smart moves in trying to develop strategic relationships across the ecosystem and not have too much over-reliance on one vendor. We're seeing this, across the board as all of the hyperscalers develop their own chips. And any time that you have such capital-intensive requirements, you need to get creative with financing. I think this isn't new in technology, and it's not new in other parts of the market. We've certainly seen it with, auto manufacturers financing the dealerships to get the cars into the dealerships so they can actually go sell them and then pay back the automakers. It's not a new concept. The important thing is that the demand is real and not speculative.
But the interesting thing to me is that the numbers are just so big, it's impossible to even contemplate how much money it's going to cost to build 26 gigawatts of power is what's going to be needed for the deals with NVIDIA, AMD, and Broadcom. Where is that generation going to come from? Because you don't build a nuclear plant in just a year or 2 or 3 or 5 years. It takes like a decade.
I think people are getting as scrappy as they can, and you can see people just hoovering up every power source they can get access to, clean or otherwise, nuclear or otherwise. I'm glad to see that the U.S. is trying to clear the way from a regulatory perspective to get access to this power, because if we want the U.S. to maintain our lead in AI, we're going to have to solve this problem. And I don't have all the answers for where it's going to come from, but I can tell you there are projects going on across the country, especially in states that are more friendly from a regulatory and permitting perspective to get this power online as quickly as possible. It's a gold rush for power.
Erica, I want to talk a little bit about the physical footprint here. I was reading a note from Peter Bukvar this morning. He says that he would never invest in the physical structure of a data center. He makes the good point that you think about how big some of these projects are. You think about the equipment and the chips that are currently being installed. Technology tends to get faster. It tends to get smaller. And there's this real concern out there that perhaps we're overbuilding when it comes to data centers, when it comes to the physical infrastructure. And I wonder how you think about that worry.
Yeah, we've heard that, and I think a lot of people are pointing to what happened to fiber, right? We overbuilt fiber in estimating a lot of demand that then took a long time to materialize. It is true that demand and consumption sources, I think, are going to shift over time, but the reality is that we are in this fundamental sea change from a technology perspective. I do believe that AI is going to transform every aspect of the world that we live in. And while the systems are going to get more efficient, the way we use them is going to get more efficient. I do think that over the long haul, all of this capacity is going to get used, even if we see a temporary slump at some point. And I would say that I think, if you're trying to play to win here, being vertically integrated and having control over everything from the land to the power to the chips to the space to the operation of these data centers is going to be of paramount importance, and also give you a lot of control over your margins over time. It's the smart play. And so I think we see a number of companies pursuing that strategy. And I think it's really smart, actually.
Absolutely. Well, let's use that as a jumping point to talk about some of your investments. I looked through some of your recent portfolio additions. I know you're hot on construction, on architecture right now. Tell us why.
Yeah, I mean, Trunk Tools, AI for construction, incredible company. If you think about the work that goes into construction, there's obviously the people building the buildings, but there are millions of pages of documents that inform that work. And what's fascinating is that 10% of all of construction work is rework because somebody made a mistake. They built the wrong thing. They misunderstood the spec. AI is the perfect solution to this problem. We can eliminate that 10% of rework by looking at all the construction data, getting ahead of gaps in information or conflicts in documentation so people know what to build, when to build it, and can finish construction projects on budget and on schedule. And, AI just unlocks this incredible potential to do that was never there before.
Does it change? In looking at your resume, you were a founder or a co-founder of Bitnami, right, which went through Y Combinator and was eventually bought. And then Microsoft brought you in to be the CEO of GitHub when it really wanted to scale that business. So you've seen the smallest of businesses and, the biggest corporations in the world at work. Are they operating in a way that's in a sense closer together now as you see something like OpenAI go from startup to one of the most important companies on the globe?
Yeah, it's a great question. And I think there's a huge variance, and depending on which companies that you look at. Some are really embracing AI and putting it at the forefront of their product strategy, and it's showing up. And others are having a very hard time catching up. So, from an investment perspective, it's an exciting time to be backing companies like, going back to trunk tools, that can get in there and really innovate and change the way that work gets done in an industry. And I think we're going to see a lot of shifts in the power balance across these big incumbents and these upstarts who are able to move a lot quicker. But with that said, I mean, companies like Google, who quite frankly seem like they were fumbling the ball despite having every ingredient necessary to win here, really seems to be catching up and starting to execute and move much more quickly. So I think the incumbents are having no choice but to try to speed up the way that they're working. But we will see some fall out, and some of these new startups come to the top of the pack. And, that's what makes the startup ecosystem so incredibly exciting.
Well, Erica, great to get some time with you to break it all down. That is Erica Brescia. She is managing director over at Redpoint Ventures. Now, coming up, the latest on the ceasefire deal in the Middle East, straight from our own Oliver Crook, who is on the ground reporting from Jerusalem. He'll tell us how this historic day may shape geopolitics and the United States' global standing when we return. This is The Close on Bloomberg. Well, President Trump participating in a signing ceremony for the ceasefire ending Israel's war in Gaza, calling this the historic dawn of a new Middle East in a speech to Israel's parliament earlier. It's really striking to me, Matt, too, when we saw that summit earlier, that there were almost 36 world leaders from Europe and the Middle East who were sitting behind President Trump. That happened at about 12:15 earlier
But not
today.
Benjamin Netanyahu.
No. He, of course, was at the Israeli summit, but there was a previously scheduled Jewish holiday, which was given as a reason for why he wasn't there.
Right, although he's widely known to be very flexible, secular Jew, not Orthodox, not necessarily observing. I know for political reasons he's got to do that, but I just thought it was interesting that he declined the invitation, although maybe it's more interesting that he got the invitation, right?
Yeah.
And he thanked Egypt for that invitation. So I guess baby steps, right?
Baby steps. I mean, it is a historic day, no matter which way you slice it. But the point has been made.
It is an historic day.
An historic day, and there. But the point has been made that this is a fragile piece. So let's get, of course, to our own Oliver Crook, who is on the ground in Jerusalem with the latest. So, Oliver, a whirlwind trip for President Trump, culminating in that summit that we were just talking about with nearly 36 world leaders behind him. What do we know about the president's next movements? And, of course, what tomorrow looks like in this new Middle East that he spoke about?
I think ever since October 7th, 2 years, just over 2 years ago, the day after the war would come to a close in whatever way it would, was always going to be the big question. That is going to be the great unknown going forward into the coming weeks and months. As we've been discussing, I mean, the end of the war, so-called, at least a ceasefire or some sort of temporary peace agreement, which is what we have now with the release of the last remaining living 20 hostages who were this morning in Hamas custody and have been given back to the IDF and are now with their families in Israel, is absolutely momentous. And I think that a lot of the credit, certainly from the Israelis, but really on the world stage, goes to Donald Trump for having achieved this. But as you say, the sort of joy that surrounds the events of the day today mask a sort of bitter complexity that we still have before us in the coming months, in the coming weeks. Because before you can get to any conversation about governance over Gaza and whatever the so-called Board of Peace that oversees that is going to be, are the security guarantees that exist within the Gaza Strip that should not be furnished by the IDF for the foreseeable future. But the question is, what kind of force that is both credible with Israel, credible with the Palestinians, can be installed in Gaza to secure that kind of peace? And that, of course, prompts the major question, I think, the immediate question in the coming days. And the answer to your question is, what is the future of Hamas? This is an organization that has not said that they're going to disarm quite yet.
Oliver, I got to cut you off there. That brings us to the end of this block. Oliver Crook in Jerusalem.
For me, the risks are to the downside for the labor market. If you look at the data, we're in the early stages of tariff pass-through. Businesses are, for the most part, absorbing the shock. We know this from earnings calls in Q2. And we have also heard from businesses talking about increasing the tariff pass-through going forward to consumers.
And that was Oscar Munoz, Chief U.S. Macro Strategist at TD Securities, kicking off the show. And Matt, you're filling in right now for Romaine Bostic.
And I'm honored.
You should be. You also have the good fortune of joining us on a big up day in the market.
That's right. And it looks like we're continuing to build on those gains into the close. This must feel like, in some senses, a mirror image of what happened on Friday, right? Because we had a big drop, especially after President Trump, or I guess triggered by President Trump's Truth Social post that he might put 100% additional 100% tariffs on China, and then it snowballed into a 2.7% loss for the S&P into the close. Right now we're back up 1.6%. So we lost 182 points on Friday. We're gaining back 103 of that, at least on the S&P. So investors certainly are buying this dip.
Yeah, absolutely. Though, of course, we're still in a hole for the month, which you pointed out to me earlier. But let's keep the conversation going now with Jason Pride. He is Chief of Investment Strategy and Research over at Glenmede. Jason, great to have you with us. You think of just the past 2 business days in the stock market. There's so many cross currents when it comes, of course, the fact that we still have a government that's shut down. You have all these different trade tensions playing out, the U.S. and China chief among them. And then you have OpenAI signing deals left and right. And, of course, Broadcom is your biggest points contributor to the S&P 500 right now. What is noise and what is signal currently?
Thanks, Katie. Thanks for having me. And I'm glad we didn't go down the direction of giving Matt too much credit for this this rebound here. This rebound, we think today, is very much a relief rally from the downturn that we had on Friday that was surrounding increased tariff concerns around the supply of rare earths, which would have disrupted the technology ecosystem that we currently have. We've now backed off on that. I think the rebound actually makes a lot of sense. Is this noise? Yeah, I think it's noise, but it's also representative of one of the risks that sits behind the system here surrounding rare earths for this economy. China has cornered the manufacturing and production refinement of rare earths to some degree, not necessarily the supply. We could actually be attacking that and getting the supply, but we're not there yet. And until we get there, this is one of the linchpins of the technology story and a piece to our economy that is at risk. This and the shutdown situation are kind of distractions from what is otherwise, we think, a decently healthy ongoing economic and market expansion, but one that still has risks that could knock it down a little bit if they were to come through.
Well, Jason, to that point, you think about the potential risks to the economic cycle that we're in, which, as you say, is still good. I have to imagine that 2 of those big risks are, of course, what happens on the trade front, and then also if the shutdown continues to drag on and stretch into weeks and potentially months.
Absolutely. We've been kind of putting a little bit of an estimate to the economic impact of the shutdown. As of right now, we think there's about 0.2% impact to overall GDP during this quarter period due to the shutdown. Every week that it extends, we estimate that's probably about another 10 basis points impact on GDP. Now, historically speaking, once we get out of the shutdown, that lost economic activity is recouped on the other side. So long-term investors can kind of look at this as something they can look through, and that's what markets are generally doing right now. Doesn't mean it doesn't cause some disruption and some volatility, but right now investors are looking through it. Tariff-wise, we're basically looking at a tick up of about 50 basis points to 100 basis points to inflation coming into the end of this year, beginning of next year. That'll be the primary thing the markets will be dealing with. And I think that's generally priced in at this point in time and turned into expectations. So both of those items I think we can get through, but there are definitely risks that are on the table.
Jason, you mentioned, the cause of the sell-off on Friday. We were talking about President Trump's Truth Social post, but then we have this bounce because yesterday he seemed to walk that back. But you mentioned the rare earth export curbs and even bans, as Meredith Whitney pointed out in a note yesterday, bans on exports of rare earth minerals to anyone using them for defense purposes like Lockheed, like GE, like Fluor. I wonder if that risk isn't being underpriced, because I guess we're starting to gather some rare earth minerals here, but we're certainly not going to be refining them at any scale, and not for years to come.
This is an ongoing risk, Matt, but I think it's a risk that investors at this point in time, maybe you can consider it to be under-recognized, or it may be a risk that investors are saying, we're gonna wager on the idea that these two parties, U.S. and China, will continue to play reasonably nice together, because if China were to completely restrict our access to rare earths, we would retaliate with the larger tariffs. Larger tariffs would be negative to their economy. The lack of rare earths would be negative to our economy. It's kind of a no-win scenario, whereas if everybody plays nice in the sandbox on an ongoing basis, both economies generally win out. So there's kind of there's an interest in mutual beneficial outcome rather than mutual self-destruction.
I want to ask about the earnings fundamentals as well, because DataTrek, Nick Colas put out a note this morning that I thought was really cool. It showed that, outperformance in terms of earnings was 8% in Q1 and Q2. And Nick says, we might have to get over that hurdle again in Q3 if we want to keep this bull market going. Yesterday was the third anniversary of this bull market. We're up like 85% over the last 3 years. Do you think we can keep it on for a fourth year? And do you need earnings to grow by that much, or to beat by that much, I should say?
Well, we definitely need to have earnings growing. I think earnings growing somewhere in the ballpark of 10 to 12% would be nice to see across the broad market. I think we're clocking in higher than that for the Mag 7, lower than that for the rest of the market, while the rest of the market is starting to catch up. The bar is set perhaps a little bit higher for the Mag 7, given how they've delivered recently, and lower for everybody else. And actually, if you look at the full economy, the full market spectrum, small cap is starting to clip in at above 15% rates. Second quarter is above 15%, right. Actually 18% range. Third quarter is going to be even stronger. We think this market can actually widen out on that basis.
All right, Jason, that's a good place to leave it. That is Jason Pride. He is Chief of Investment Strategy and Research over at Glenmede. And of course, we have earnings season starting somewhat unofficially this week with the big banks kicking us off. But as for right now, we are moving closer to that closing bell. Full market coverage right here on Bloomberg.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
About 2 minutes away from the end of the trading day, Katie Greifeld and Matt Miller in for Romaine Bostic. And here to help take us through the closing bell, we're joined by a global simulcast, Carol Massar and Bailey Lipschultz. He's in for Tim Stenovic, bringing together all of our audiences, Carol Massar, to parse through the most crucial moments of this trading day on this Monday. And the dip buyers, they're back.
Yeah, right. What a different tone from Friday. But, also we got to write a love letter to OpenAI and Broadcom, because the semiconductors, really some outperformance, up about 5%. A lot of it, Bailey, had to do with Broadcom today.
And who even cares about a government shutdown in a market like this? Yes,
we barely talked about it today.
Didn't even mention it. Didn't even cross our minds. And yet the major averages are up almost 2%. S&P up more than 1.5%. And Katie and Matt, guys, the bond market's closed, but stocks are partying.
Yeah, I think to some extent the administration took the teeth out of that shutdown by agreeing to pay, or finding the money to pay, the military, at least on Wednesday when the next check is due. But I think it's really interesting that we've gone so far so fast. BTIG was out with a note yesterday saying that we're still above the 50-day moving average and have been for 113 days. That's the third longest stretch since 1990. That's before Bailey and Katie were even born.
That might be true, actually. But, it's a good point that we have been so strong for so long, and we really haven't seen a dip to buy in quite a long time. So, of course, a lot of this is OpenAI, but a lot of this is just folks seizing on a sale right now, and that definitely was the story of this market action on this Monday. You can see the S&P 500 looks like we're going to finish about 1.5% higher. You take a look at the NASDAQ doing even better. That's a lot of that chip influence coming through there. The NASDAQ finishing 2.2% higher on the day. We show the Dow Jones here. I wouldn't. It's not my favorite index, but we'll do it. It's up about 1.3%, Carol Masser.
I know. What's wrong with the Dow?
She likes the small caps
The
better.
thing is, it's a price-weighted index. How much of a signal can you glean from that?
Matt, remember way back when we only used to talk largely about the Dow?
I remember Dow 6,000.
I know. Wow. All right, let's go to the S&P 500. We'll put the Dow aside for a moment. Most names in the index higher, guys, today. 359 gaining ground, 142 to the downside. Matt, 2 unchanged.
Take a look at the industry groups moving higher, and you'll see pretty much all of them that aren't defensive did so. You've got consumer staples down, and if you look at the S&P, which is, I think Katie agrees, much better yardstick.
It's the index.
You can see that you had a lot of consumer staples on the downside. Procter & Gamble. You had Philip Morris at one point, one of the biggest losers on the index. Altria Group also. These are things that, you either need to buy again every month or you're just addicted to, so you have no choice. But for the most part, you had every other group rising. Healthcare you see down, but really just unchanged.
All right, guys, let's get to some of the individual gainers. No surprise, I'm going to talk about Broadcom. Of course, ticker AVGO, up as much as almost 11%, finishing the day with a gain of just shy of 10%. Number 2 gainer in the S&P 500, number 1 gainer in the NASDAQ 100. No, number 2, forgive me. But nonetheless, really just pushed the whole semi-sector higher in today's session. This has OpenAI signed a multi-year agreement with Broadcom to collaborate on custom chips and networking equipment. So it's the latest step in OpenAI's ambitious plan to add computing infrastructure, but it really gave some juice to Broadcom. All right, the other thing that was kind of a broader story today was when you look at rare earth and critical mineral stocks, rising, falling, strong gains among Asian peers, fresh tensions between Beijing and Washington over China's exports of critical minerals, fueling bets on alternative suppliers. So 2 names I just want to show, critical materials, critical medicals. Yeah, try this again. Shall we try that again? Take 2, everybody. 3, 2, 1. Critical metals up almost 55% in today's session. And then MP Materials up just about 21%. Remember, MP Materials is the one that the U.S. government has taken a stake in, along with some other investments in raw materials companies. And then I got to mention Warner Brothers, up almost 4% here. This as the company, according to reports that cited people familiar with the matter, rejected Paramount Skydance's initial takeover approach for being too low. And
can I just...
Go ahead.
Can I just interject with a little bit of an editorial comment?
This is very Romaine of you, so go ahead.
I know. I'm like, what?
Well,
I thought I could get through it and then just pass the baton.
Well, no, because, Carol, because you and Tim were there at Screen Time last week.
Yeah.
And Lucas Shaw's conversation with David Ellison was amazing.
It was amazing.
I understand so much more about the company, about the industry, about their aim.
That's funny because Laura Martin of Needham said, she goes, I don't feel like that David Ellison has really laid out his strategy. What? That he keeps making these acquisitions but not kind of saying what the overall strategy is. I'm just sharing you because she talked with us at Screen Time.
I just thought it was good. So good.
It was
Go back and listen to it if you haven't. Yeah.
Or buy tickets for next year. Bailey, there were stocks that fell today.
There are stocks that fell today, and the worst performer in the S&P 500 is not in the Dow Jones Industrials, Katie. That is Fastenal, ticker FAST, falling the most since March 2020. This came after earnings. CEO told Carol and I that their stock was actually priced to perfection, and that's why they were down. But analysts called out some soft pricing, overshadowing results that at the top line actually weren't that bad, and I want to call out this second and third worst performers in the S&P 500. Casino stocks. We saw both Las Vegas Sands and Wynn Resorts under pressure, each falling more than 6%. Not because people aren't going to Las Vegas, but there's a holiday on the other side of the world, and that's Golden Week, and we saw Macau data disappointing. So investors really selling down those 2 stocks. Again, Las Vegas Sands, ticker LVS, down more than 6%, worst drop since earlier in the month, but closing at the lowest level since June. And guys, I just want to wrap up with one of my favorite stocks to cover, Beyond Meat, ticker BYND.
Is that because you like to eat it?
I do not like to eat it. I question it. It's a little concerning how it bleeds, but it was at one point one of the best stocks to IPO
That
ever.
was very real.
It was it's a very logical, fundamental argument, at least when the stock was trading for whatever number it was, but closing at a record low, losing about half its value. This came after debt investors swapped their notes for shares, diluting investors. So it does seem like a slow burn to the end for Beyond Meat.
Yeah, pour out some beet juice for Beyond Meat. The bond market was closed today. It was one of those weird days where equities were open, bonds were closed. I wanted to take a look at TLT here, though. This, of course, tracks 20-year treasuries and beyond. And you can see that it's just about flat on the day. It opened up lower. That would have meant that yields were higher, but you can see it finished just about unchanged. So that sets us up well. Shall we talk about Taylor Swift, though, because she did have an impact in the stock market here.
I wonder if, Carol, if you know the way that Katie talks about Taylor Swift and her impact or her importance.
Very respectfully. Yeah, I call her.
What do you say?
I call her the Bob Dylan of our generation, the millennial generation, for millennial women, and I'm willing to back that up. I'm not the biggest Taylor Swift fan out there, Carol. I am a huge fan, but just in terms of her impact, I think that that's a pretty fair characterization.
Well, you know what's interesting? You talk about impact, and some of it is just what she does up on stage, fighting for rights in terms of owning your own material, if you will. But she's also become pretty wealthy, and with money comes influence. And I just want to mention, I know we're going to go back to Taylor, but there's an interesting story on the Bloomberg about how kind of Wall Street's been getting ready for this incredible wealth transfer of like $105 trillion to pass from elderly parents to children. But Bailey, there's actually a different kind of wealth transfer already underway, and we're talking about women who are actually becoming billionaires after the death of their spouses.
Yeah, Bloomberg reporting that more than a dozen women in the world's 500 richest people have become billionaires because of that, overseeing fortunes totaling $365 billion. That's a lot of money to be falling into.
Yeah, and it means a lot of influence, whether it's philanthropy, finance, consumer goods, like a lot of things. So now we go back to Taylor, who is pretty wealthy, and she's influential.
Katie and I, we used to co-anchor a show called Bloomberg Open Interest.
It still airs, I'm told.
9 to 11 weekdays, tune in. We talked to Sally Krawcheck on that program, if you recall, and she said that we're going to see, I think, massive numbers, like $35 or $40 trillion shifted in this silver tsunami. Maybe it was even more, but the lion's share of that is going to shift from the control of men to the control of women. So that's going to be...
As it should.
It's really interesting, too. You think about all the different ripple effects there. One of them being, what does this mean for the financial advisor community? There are a lot of things that we'll have to adjust to sort of accommodate what that new face of wealth looks like.
I heard Carol and Tim talking to April Rudin about this last week.
Oh, my God. I'm so... I'm just warmed.
He's your biggest fan, truly.
I thought we were going to talk about
Taylor Swift,
the docuseries.
She's going to make a 6-part docuseries about the Eras Tour, which, regardless of how you feel about her music, even if you think that she only had one good album in her entire catalog, the one about the cardigan and
which is folklore,
exactly,
1989, but sure,
you still can't deny the impact that her Eras Tour had on the global economy. Really,
I saw it in Toronto, and let me tell you, that was a production. I was tired just watching it.
Do you know she used to practice singing a song on a treadmill to get herself in shape?
Didn't know that. I tried it once. It didn't.
All right, we got to go before we get yelled at by Finley. All right, that is a wrap. Our cross-platform radio, TV, YouTube, Bloomberg Originals. Katie and Matt, of course, continuing there on the close on TV, and Bailey and I continuing on Bloomberg Business Week Daily right here on radio, YouTube, and Bloomberg Originals. We will see you again, same time, same place tomorrow.
Well, coming up on the close, amid all the geopolitical headlines and the government shutdown icing out economic data, Federal Reserve Chairman Jerome Powell is still set to speak tomorrow. We'll discuss what tone to expect with Thomas Hoenig, former president of the Kansas City Federal Reserve, next. This is The Close.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Katie Greifeld.
And I'm Matt Miller. Let's take a look at where the markets closed out the day. We had a big rebound after the even bigger drawdown on Friday. S&P 500, though, gained back 102 of the 182 points it lost after President Trump said he might consider an additional 100% in tariffs on China. He backed off a little bit on Sunday, and that's why we have a rally here. Part of the reason that we have a rally. The NASDAQ up 2.2%, 528 points, I think driven also in part by the Broadcom deal with OpenAI, the third of its kind in recent months. Gold at an all-new record high, $4,107 a troy ounce, and NYMEX crude coming up 1.4%, but from a very low level and still holding under $60 a barrel.
I have to say, it's just amazing to see that strong move up in gold at the same time that you have, of course, equity shares moving higher as well. Let's get to some of the specific reasons why it was such a strong day. Matt mentioned it, of course, that OpenAI deal with Broadcom. OpenAI agreeing to buy Broadcom's custom chips and networking equipment in a multi-year deal that sent Broadcom shares up 10%. It lifted the entire chip-making sector as well, though. You can see NVIDIA up about 2.8%. A different story for Fastenal. Shares there falling pretty mightily, 7.5%. Third quarter EPS and operating income missed estimates. That was, I believe, your biggest loser on a percent basis in the S&P 500. But let's get back to our top story this hour, and that is the U.S. government shutdown, leaving investors desperate for a fresh read on the economy. Now, Fed Chair Jay Powell set to speak tomorrow in Boston, with traders eyeing any clues ahead of the central bank's meeting at the end of the month. This, as markets digest President Trump's escalating tariff threats in a standoff with China, Matt. Certainly a lot of cross currents to try to keep track of.
Yeah, let's bring in Thomas Hoenig to help us. He's former Kansas City Fed president, of course, distinguished senior fellow at the Mercatus Center at George Mason University. And we're glad to have, Thomas, you with us. Let me get first your take on the China back and forth. President Trump, it would seem like manufactured this problem and then solved it in 3 days. But really, it goes back to, at least in the most recent incident from China, they are talking about curbs on rare earth minerals, which we desperately need for our automotive and consumer products manufacturers, but even more desperately for military purposes. And on that note, China says it's going to ban those exports. Are we underpricing this risk?
Well, I think I don't think so. I think it is a true risk, and I think the United States is well aware of it. I also think there's a little bit of a lot of confidence that Trump, while he goes back and forth, will want to make sure that rare earths are still sold to us. I think as they prepare for this interview, and I'm not a political expert on this at all, but I think the fact of the matter is China wants leverage with us. They want our technology, our AI technology. They want open, so they're going to press on us to do that. So this is really part of the back and forth, the gamesmanship that's going on between two major countries. And it does create uncertainty, and it does hurt the economy. But I think most people are of the opinion, especially on the market, that the government will do whatever it takes to keep this economy strong, and therefore some kind of agreement will be made.
I'm just thinking, from an inflation perspective, it's just got to add more upward pressure. I mean, Katie was just doing a story on Fastenal. I talk to the people who run Ford and General Motors all the time. These companies need steel and aluminum, and they're already paying 50% tariffs on that. You know, if you have to pay ever more for your chips as well as your rare earths, which for some reason, you know, we've engineered our products so that we need these for everything. Doesn't inflation just continue to head higher and higher and higher? And we're already above 3%.
Well, certainly that is likely. I think inflation is entrenched at least 3%, most likely to go up, not only because of the tariffs, which are, I think, a factor, but also because of the policies of the past. We have an enormous amount of money sitting on the side waiting to be spent. There is a fair amount of demand. I think we're in an inflationary boom right now. We see it in the stock market, but we see it also, I think, in a very, shall we say, persistent consumer who's not really backing down from the market. They're staying in there. So there's a lot of demand in this economy, and I think it's going to go forward. And the Fed put a lot of liquidity into the economy in earlier times, and that liquidity is still there. in many respects. So yeah, there's going to be continued inflationary pressure for at least the next 6 months, I would guess, at least.
So, like you said, for at least the next 6 months, probably inflation pressure to the upside. Let's talk about the reality that we're not getting government data when it comes to inflation. We will get the September CPI report that was supposed to come out this week in 2 days' time. I believe it's coming out on October 24th. But the BLS isn't even collecting the figures that they need for the October CPI release. So from your position, you know, as someone who has sat in the room when it comes to making policy, I mean, how much of a bind does this put the Federal Reserve in when they're trying to navigate and sort of control the path of inflation here?
Well, it does mean they're flying a little more blind than they would like. There's a lot. It makes it more difficult. Clearly, they are going to rely, and they always have, but they'll rely particularly now on anecdotal data, on their survey data. Each reserve bank runs surveys constantly. They'll be looking at those survey data that they get in, and they'll be trying to make judgments on that basis. And I think because of that, the speakers, whoever they are, will be very cautious in what they say, but they'll still be, I think, on balance, expecting that the economy will continue to move forward. One other thing I'll make real quick as a caveat, I think Powell will be very careful in terms of forecasting anything about their next moves. They just don't have enough information, and so they're going to want to play it as close to the vest as they can.
All right, well, we're getting closer and closer to that October Fed meeting. It's going to be fascinating to hear the tone at that press conference. But I would love you to weigh in on the two sides of the dual mandate from the Federal Reserve right now, because a lot of folks have made the point that they're in conflict, that you have inflation, as you say, pressured to the upside. At the same time, there's a lot of concern about the labor market and whether or not it's going to materially weaken from here. So when you examine both sides, which do you think is more urgent at this juncture?
Well, I think if inflation is more urgent, I mean, you have an inflationary expectation, I think, that are changing. When I talk to people, there's a very increasing awareness, not just of the inflation rate, but how much prices have increased, the level of prices. People are much more sensitive to that. It's affecting their behavior. And I think therein lies where the focus should be. I think the Fed has allowed itself to become so sensitive to not disappointing people about the employment numbers that they are forgetting one of their primary, what I think is their primary mandate, along with employment, and that is keeping inflation. And I remind people, inflation at 3% is way too high. Inflation at 2% is not price stability. Price stability is much closer to, shall we say, between 0 and 1%, and yet we're at 3% rising, and we're focusing on the politics of it, focusing on employment, when I think in the long run, what we've learned in history is when you let inflation get out of hand, unemployment will eventually rise much more sharply than you want or expect.
And yet this Fed seems to have no problem with inflation that's more than 50% above its target. And as you point out, its target is already too high for a lot of people. Right. Why do you think it's not as important to the people on the FOMC right now?
I think it's the pressure they're feeling. There's a lot of pressure from the markets, not just from the administration, about keeping interest rates low. I also think you have a lot of pressure on them in terms of focusing on other things besides inflation, because they're going to see a lot of pressure as the national debt, the new deficits, which will be $2 trillion, continue, and the total debt rises above $38 trillion. Who's going to fund that? The Fed's going to be under a lot of pressure to do that. I think they're losing track of where they ought to be. They ought to be focused on stable prices, focused on convincing the Congress and the administration to get the debt under control. If they don't do that, they're going to lose control of inflation and their mandates, both of them.
Thomas, can I quickly ask you about the Mercatus Center? I've always followed it closely and thought of it as a place for classical liberals, people who celebrate, yes, free market capitalism, free trade, sort of a libertarian bent. How do you survive in this kind of political atmosphere?
That's a great question, and we think of it all the time. I do anyway, and that is, we are classical liberal. We are for markets. And with that, you can't have good working markets without stable prices. And that's where I think we come from. And I think we just, you stay on point, you stay with your principles. It's when you leave your principles that you get yourself in trouble. And I don't think Mercatus has any intention of abandoning their classical liberal views, or certainly I don't.
All right, Thomas, have to leave it there. Fantastic to get some time with you. That is Thomas Hoenig. He is former Kansas City Fed president and, of course, distinguished senior fellow at the Mercatus Center at George Mason University. Now, coming up, more fallout from First Brands as the CEO of the auto supplier steps down. We'll discuss next. This is The Close. Well, the First Brands saga continues with CEO Patrick James resigning from the auto supplier with more than $10 billion owed to some of Wall Street's biggest names. Joining us now is Bloomberg finance reporter Katherine Doherty. She has been all over this story, and one of the reasons why is because Jefferies has really been at the epicenter of this fallout, having a very good day today, though, up about 5.6%. What do we know?
So last night, the bank came out with a very detailed statement. This was a letter from the CEO, Rich Handler, and President Brian, and they are coming forth and basically answering in a Q&A format. And this is both for their investors and for their employees, too, how the firm is potentially exposed in any way or involved with First Brands. So this is in the form of various investments through Point Bonitas. This is the unit, the asset manager, that is backed through Leucadia, and Leucadia is a fully owned subsidiary of Jefferies. So they're basically going through and ticking and explaining the details of not just the investments, but their involvement as an investment bank. So they even detailed the various deals that they've been involved in, whether it was an M&A deal or a loan that they helped facilitate. They're quelling the fears that clearly were taking a hit to their stocks. And what you're seeing today is some of that being recovered. And so whether or not that this was clearly their intention was to help quell the fears that were out there and rumors that have been circulating for weeks now. But whether or not that will be the end of the story, that's what's to come.
Doesn't seem like it. I mean, the DOJ has started an investigation, right? We heard from one creditor that $2.3 billion of assets, I think receivables, has vanished. Does Patrick James need to get lawyered up here?
So that's the other big story that dropped today. The CEO of First Brands has stepped down. As a replacement, they have their chief restructuring officer. This is very typical in a bankruptcy process. But what is not typical is how this situation is unfolding as the investigation is underway. These kind of questions of, are these receivables going to be recovered, is something that will play out over time. But this is as the company is marketing itself. There's going to be a sale process eventually, and you can't sell your company until all of these questions are answered and everything is cleared up. But this is temporary management that is in place now.
All right, Katherine, great reporting as always. That is Bloomberg finance reporter Katherine Doherty. Coming up later this hour, an interview with the CEO of Ethan Allen. We'll be talking tariffs. This is Bloomberg. All right, welcome back to The Close. I'm Katie Greifeld. Alongside me is Matt Miller. Of course, you're taking a look at a stock market that managed to close in the green, recovering from Friday with a big thanks, of course, to that AI flywheel, driving stocks to all-time highs. It's drawing comparisons to the 1990s dot-com bubble, but our next guest says that the concerns likely overblown. Joining us now is Bloomberg opinion columnist and Unison Advisors founder Nir Kaissar. Nir, great to have you with us. And let's start right there. You hear that comparison all the time, that this feels very dot-com-y. Folks can build a whole bunch of bear cases on top of it. Why is this time different?
Hi, thanks for having me. Yeah, I think I hear those comparisons all the time. And I think the comparisons are natural because this market is expensive. And by many measures, the only time it's been this expensive is a few years ago before the 2022 tech crash and the dot-com bubble. But where it's different is this is a much higher quality market. In general, the companies on a weighted average basis, in this market are a lot more profitable, and they're a lot less levered compared to .com. In fact, if you looked at profitability, I looked at return on equity on a weighted average basis for the S&P 500. This market is more highly profitable than any market since at least the early 1990s, which is what we have data to go back for, and maybe even before that. And the reason the profitability is so important is because profitability ultimately is what feeds the earnings growth. And the earnings growth ultimately is what pushes the stock prices higher. It's why, all things equal, more profitable companies are going to trade for higher multiples than lower profitability companies. And so it stands to reason that if you have a more profitable market, you're going to pay more for it than a lower profitability market. And that's where the comparison to .com breaks down, I think.
What if we get, antitrust scrutinies? What if we get, we're already in a higher rate environment, right? These guys, the big earners, the Mag 7, are benefiting from a decade of near zero interest rates. And I don't want to say monopolistic advantage, but some would say that. Is it sustainable, you think, these kind of earnings?
That is the million-dollar question. And I think the answer is we don't really know. And given that we don't know, what is the best way to think about that? A couple things to be said about that. One is that, for a long time, for most of my adult lifetime, the governing assumption was that profit margins are mean reverting. And so if you see a high profit margin, you can assume that it's going to go down, and that will drive down the valuation. That's something that you can bet on. However, we've had high valuations for a very long time on the back of high profit margins for a long time. And that has to make you stop and at least consider the possibility that what we're seeing is an economy that has moved more from a heavily manufacturing economy to more a service economy to more a technology-driven economy, where profit margins are naturally higher, and naturally higher profit margins are going to beg higher valuations. That may explain this. Now, that doesn't mean that it can't be thrown off course for all the reasons that you mentioned. But the question is, how do we think about the probability of that happening in the future? And my default is always the market is the best guesser. So look at the market and see what it's implying for growth rates, it's implying for profitability. And I try to do that. I try to look at the growth rate that is implied by this market based on its pricing. And I came up with a growth rate of about, depending on where you look, for the big tech names, about 8 to 9%, for the broad market, about 5 to 6%. And as long as that's the case, and that's effectively what the market is signaling today, then it doesn't look like there's going to be a repricing anytime soon. But that's the thing to keep an eye on, because obviously, if those profit margins, if that profitability is knocked down, then a repricing has to happen, no choice.
Well, Nir, I'd love to get your thoughts on one of the other bear cases that's been working its way through the market narrative, especially over the last week as we watch all of these AI deals get inked. You have a lot of overlapping deals, a lot of them involving OpenAI. And the concern is that you have a bunch of companies tying their fortunes together. It's an interesting daisy chain that's being formed right now. And if there's a hiccup at one of them, then it threatens to bring the whole complex down.
Katie, there's something interesting about that because, quality is a three-legged stool for most people. It's about profitability, it's about leverage, but it's also about the reliability of earnings growth. And one of the things that we do see in the data is that earnings growth in recent years has been a lot more volatile than it has been, certainly than it was during the dot-com era. And the question is, what does that mean? And it might go to what you're talking about, which is the interconnectivity of these companies can be great. It can be synergy. It can promote higher profit margins, but it can also create a domino effect where if there's a hiccup in one place, it can rip through everything else. And that might explain some of the earnings growth volatility that we've seen in recent years. And if you just look at the last 5 years, we've had a lot of volatility in general. People already forget what 2022 looked like because we're a few years past that. But that was an ugly period where the NASDAQ was down about 30%, and a lot of people were calling the end of this sort of at least short-term AI revolution. That didn't happen. But the reason that volatility is there could be because of this interconnectivity we're talking about. So I would say, yes, keep an eye on margins, but also be aware that there's more volatility in the profitability and earnings growth than we've had recently.
Well, it's a very cool run through the numbers, Nir. I have to say I was citing your story all morning with my guests on Bloomberg Open Interest, which I typically anchor from 9 to 11 weekdays. Thanks very much for joining us, Bloomberg opinion columnist and Unison Advisors founder Nir Kaissar.
Well, we're here on the close, so let's take a look at how markets closed on the day. It was an up day in the S&P 500, trying to climb out of Friday's hole higher by about 1.6%, led, of course, by those semiconductors. That's showing up in the NASDAQ 100, up about 2.2%. Gold has been fascinating. I don't know how much you talk about it on the open, but this twin rally that we're seeing in risk assets and the ultimate safe haven has just been breathtaking. That was the dynamic today. And we also have crude on the board as well, higher by about 1.2%. This is the close on Bloomberg. Welcome back to the close. Starting tomorrow, tariffs on imported lumber and wood products will go into effect. Retailers warn that the duties could raise furniture costs, leading to higher prices for consumers. Joining us now to discuss the impact on the furniture industry, I'm pleased to say, is Farooq Kathwari. He is the CEO of Ethan Allen. Great to have you on set with us.
It's always a pleasure to be here.
So you take a look at the president's stated motivation for this. He talks about how he wants to make North Carolina great again, that we've lost our furniture business to China. Ahead of these tariffs going into effect, talk us through Ethan Allen's global exposure here and what you've done to prepare.
Yes, we are better positioned. So Ethan Allen started 93 years back in the Green Mountains of Vermont. In fact, the name Ethan Allen came because Ethan Allen, the founder of Vermont, came from the Green Mountains. So we had two entrepreneurs right from New York who went there and started it. So 93 years back, we started a manufacturing company. Then as time went by, we started operating what was called Ethan Allen Galleries, operated by very great independent entrepreneurs. Now, 20 years back, many of them started retiring. So we decided that we would get into the retail ourselves. And today, 80% of the retail, approximately 170 Ethan Allen design centers, are operated by the company. So that's one side. But when we went to Vermont, when these two entrepreneurs went to Vermont in 1932, they started making furniture. They established manufacturing. And over the years, they established manufacturing right across North America, from New Hampshire to New York to Midwest to California. Well, then, 20 years back, manufacturing started moving overseas.
Right.
So we had to decide, what should we do? So we said, no, I decided that we will stay in America, but the United States alone was not going to do it. So we decided to go south of the border. Most people were going to East Asia. And we said, no, we have a tremendous amount of opportunity south of the border. So 20 years back, we went to Mexico and established at that time a 50,000 square foot plant. Today, it is 650,000 square feet.
Wow.
Then, about close to 15 years back, went to Honduras, and we established a wood manufacturing plant. And then we decided that we should make exactly the same product that is made in Vermont, in North Carolina, should be made in Honduras and also in Mexico.
Interesting.
Now, the important thing was this, which was that has an implication on our pricing, cost, imports, tariffs. We'll talk about it too. We said we must differentiate by making everything custom. So today, when somebody comes in, you place an order, that's a great wood item. It could be made in Vermont or it could be made in Honduras. A great upholstery item, sofa, could be made in North Carolina or could be made in Mexico. I don't know the difference. Our customers know the difference. But it took 15 to 20 years to do that.
So, but Farooq, will you change around your supply chain as a result of these tariffs, or will you raise the prices of the furniture you sell in order to keep your margin the same?
Well, 75% of our products are made in North America. So far, as of today, the impact of margins of duties is very little. Of course, it changes, but so far, the duties, first of all, close to half the product is made right in the United States. Then the rest is made in Mexico and in Honduras. So far, the duties are very, very small.
But if we got, for example, in other industries, when you get a 50% tariff on steel, that means those imports cost at least 50% more. But domestic producers also raise their prices like 49%, right? So do you have any plans to do something similar?
No. I think what we will do is, we have a very different business model. We have a model where people take a lot of pride in what they do. We have the largest interior design network. I just came from our design center right around the corner from here. I was talking to our designers. They take pride. Customers take pride. And if we start losing that confidence, we will go backwards. So yes, we'll take some price increases. For instance, some of our products come, even though 75% is made in North America, so far the tariffs have been limited, but they change every week.
Yeah.
So we'll see what happens. Then we have products coming from India, from other places, rugs, accessories. A lot of there the tariffs are very high.
Yeah.
So we will change some prices. In some cases, our partners overseas are absorbing some of the costs, but you're going to see increased prices. But for us at this stage, the impact is going to be limited.
Well, to your point that, it feels like the tariffs, they can change week to week. It certainly is a fluid situation, to put it mildly. Matt points out that you've been running Ethan Allen since 1988. You think about this moment in time. Do you have any sort of blueprint? Is there any other moment in time that you can compare where we are now to?
Well, I've seen a lot of changes, but every time, and major changes. As I mentioned earlier, when I took over, all Ethan Allen retail was run by independents. Then they started retiring. So I've seen changes. We had 20 manufacturing plants all over the United States. We had 10 or 12 national distribution centers and 100 warehouses. Today we have one major national distribution center supported by 2 other warehouses. Our retail, instead of 100 warehouses, is operated by 20. We have taken a lot of steps, and then technology has played a tremendously important role.
But we've had a dwindling of the labor force in terms of the actual craftsmen, right? The woodworkers in Vermont and North Carolina. Do you think if you and your competitors brought production more back to the U.S., would we have the labor force to fill those warehouses?
That's a very important issue. There are 2 factors. Yeah. One is the labor, and the other is the medical costs. I mean, these are 2 tremendously important factors. We have, at Ethan Allen, in the last, I would say, 7 or 8 years, we have 35% less people working in our manufacturing, in our retail, because of technology. Technology has been critical. So I think it's a very important issue. In America, we do not have enough labor, qualified labor. Technology has helped us so far. The second one is, as I mentioned, medical costs. Nobody talks about it.
Yeah.
It's a major issue. We can have one case and it costs us $700,000, $800,000. No such thing. Certainly forget East Asia. Even Canada is half the cost. We have Ethan Allen in Canada. Mexico, hundreds great people. And we, of course, take care of it. Like, for instance, our operations in Mexico, we provide them 2 great meals a day. We have about close to 700 people working there. We have 23 buses bringing them home. We have a doctor and medical providing still a fraction of the cost in the United States.
So you have not enough skilled labor here, and maybe the medical costs are a little bit high to do business relative to other countries. Farooq, great to have you in the studio. Really glad you could stop by. Farooq Kathwari there, the CEO of Ethan Allen. Let's stick with trade here. President Trump and Chinese leader Xi's latest tit for tat, reaching a standoff today, with China's foreign ministry saying that Beijing would respond with corresponding measures to President Trump's threat of additional 100% tariff on China. Here with more is Bloomberg's Balance of Power co-host, Joe Matthew. Joe?
No, looks like the president's taken a bit of a U-turn on this one, Matt. It feels a lot different today than it did on Friday. And, of course, the reaction, the relief rally that we're seeing in the market is the real evidence of that. Over the weekend, the president was busy on Truth Social leading up to his trip to the Middle East, saying that I have a great relationship with President Xi. He said everything with China is going to be fine, and repeated that a couple of times on social media that everything with China is going to be fine, telling people to calm down. And the fact of the matter is their meeting set for later this month at the ABAXX summit in South Korea is technically still in place. Scott Bessent confirmed that in an interview earlier this morning. He says lines of communication are still open despite what the president had to say on social media on Friday. So we can only assume that these two are going to get in a room together. And we've got the date of November 1st circled on our calendar here. That's the deadline for these 100% tariffs that the president threatened on Friday to take effect. He was asked about November 1st on Air Force One today, and he said, when I hear November 1st, it's an eternity. By the way, that's 3 weeks from Saturday. And so talks will be very important between now and then as the president tries to avoid slapping this new layer of tariffs on all Chinese goods imported to the U.S.
Yeah, one date of many circled on the calendar. Joe, really appreciate it. You can catch more of Bloomberg's Balance of Power co-host Joe Matthew at 5 p.m. today. But still ahead on the close, we're getting you set up for bank earnings with Piper Sandler's Scott Siefers. He reveals his big bank and regional favorites going into this reporting season when we return. This is Bloomberg. All right, well, one data point we're guaranteed to get despite that government shutdown is quarterly results from the banks. JP Morgan, Goldman Sachs, Citi, and Wells Fargo all kick us off tomorrow. And here to preview the results, I'm pleased to say we have Scott Siefers. He is Senior Research Analyst and Managing Director over at Piper Sandler. So a little while ago, we got the news from Goldman that they're going to buy VC firm Industry Ventures for up to $965 million. Matt makes the point that that's one trader's paycheck, which is only a slight exaggeration. I know you don't cover Goldman specifically, but what does this say about how these big banks are feeling heading in to their quarterly report card?
Hey, Katie. Well, thank you for having me. So, seems sort of small in the grand scheme of things, but probably helps to engage clients with, an alternative asset management offering. So a lot of these large banks, they're really trying to diversify their earnings streams. And to the extent that you can get something that is perceived to be higher growth, higher multiple, that's always a great thing.
I wonder about, it's been a banner quarter for M&A, right? $1 trillion of deals getting done. Now $1 trillion. Point like 00965 or something. But we had a lot of M&As, like Animal Spirits certainly came back. Mm-hmm. And then Jefferies said big volatility helped them with trading as well. They're, 1 month before all the big banks. Is that the month that had the volatility in it? Because I didn't see a lot of volatility after April.
No, in fact, I'd say two things. So when we think about the capital markets, we tend to bifurcate it into two things. One, just traditional investment banking, which is great. So what you're seeing is the debt capital markets have remained strong for longer than we would have figured. M&A, as you appropriately note, Matt, has been very strong. That's been sort of a steady performer for us. And then thankfully, we've had the equity capital markets, things like secondaries, IPOs, that has finally come to life after years of just moribund behavior. So that's great. But the additional thing that you noted appropriately is that what we would call markets activity or trading activity has stayed much stronger than we would have thought. From our standpoint, we would have figured that after we got that dislocation in April around Liberation Day, things really would have subsided quite a bit and not fallen off a cliff, but really corrected down. Instead, what we're seeing is that activity is actually staying pretty strong, and that benefits the biggest players like the Bank of America, Citi, JP Morgans, and even to an extent the Wells Fargos of the world. So it really helps to differentiate those largest banks as we head into the earnings season.
Well, Romain made the point last week, Romain Bossack, he's off today, that's why Matt is here, that the big banks, they're kind of ho-hum because they're doing well. We all know that. We all know that deal making has come back and that the IPO market has been open. That was before the government shutdown. The regionals, though, are where it gets really exciting. I know you recently upgraded PNC, for example. That's one of the underperformers on the year. They report on Wednesday. Talk us through your conviction on that specific name.
Well, you're right, Katie. So we just upgraded PNC late last week, and I think it was as follows. So first, it has been a pretty visible underperformer, despite it being one of the strongest names in the space, either from the standpoint of their income statement progression or even the strength of their balance sheet. They're about the second worst performer that we've had. So what you've had happen over the course of the year is that their historically high premium multiple has really just kind of evaporated. So we looked at it and said, okay, on a standalone basis, they've got really predictable trajectory over the the next couple of years. And when I say that, I mean their net interest income should really generate probably 6 or 7% growth out into the next couple of years. Plus, they've got really strong fee businesses such as the capital markets, asset management, et cetera, that should help them to generate really strong revenue growth. Moreover, a strong capital base and a strong credit profile as well. So we looked at it and said it's a great standalone name. It's got a much more reasonable valuation. And then as the industry sort of renews this consolidation wave that we saw begin last week with the Fifth Third and Comerica transaction, we really think PNC is in the catbird seat. They're so large that they'd be able to take a look at deals that are both large and small. So just a lot of optionality from that name.
All right, Scott, really great to get some time with you ahead of the big dance. That is Scott Siefers. He is Senior Research Analyst and Managing Director over at Piper Sandler. Really interesting to parse through these results, hear from the titans of industry who helm these big banks, and it all kicks off tomorrow, Matt Miller.
Yeah, I'm really looking forward to it. I don't know if I've told you the John Farrow quote from this morning.
Tell me.
He said, we're in a Delta economy and half the country thinks it's in Group 1. We'll find out from Jamie Dimon if that's true for the consumer. When we come back, we'll tell you what's happening in the next 24 hours.